Hey traders, in this video, I want to talk about how professional traders ride options into expiration. And I want to be clear, I'm not talking about 20-cent options that are $5 out the money on the stock, but I'm talking about when you have an options trade that is in the money. A lot of trading books and people will tell you, close them out the week of expiration or close them out early before they expire because time decay and all this junk. That's all it is pure junk. When you have an option that's in the money and you're approaching expiration, heck, don't worry because you're basically playing the stock itself. It's almost just like a stock replacement. So let's take this Keurig Dr. Pepper trade that I have on and go over this here. So in KDP, the chart yesterday was doing nothing. We've seen the market kind of be choppy. And then today, the stock has a pretty big breakout, up over 1.5%. Let's be clear. That's a big move for a name like Dr. Pepper. It's not like a Tesla where, you know, a dollar, 1.5% move is nothing. That's a big move for a food and beverage stock like KDP. So I had the Keurig, and I have the Keurig May 35 calls. Yesterday, this stock was around 35.80, so those calls were basically just no premium, just about 80 cents. Well, today the stock is at 36.40, 36.39, so those calls are worth $1.40. That's a big jump, right? That's a huge jump in the options, right? So let's go to the option chart to see what that looks like. So we have Keurig Dr. Pepper. I have these May 35 calls in my other account. I don't know why it's this one. And I'm holding them, right? So yesterday they were about 80 cents. Today they're about $1.40. Now, you might be saying, Lance, there's only one day till expiration. Aren't you scared? What am I scared of? First of all, let's think of the worst case scenario because we always want to look at the worst case scenario when doing proper risk management. The worst case scenario is Dr. Pepper goes down. Let's say it goes down to $36, so down 40 cents. Well, those options are going to go to $1. Whoop-de-doo. That's fine. I mean, they're still in the money. Or I get assigned shares at 35 bucks. Totally fine with me. I like it. I still like Dr. Pepper. I still think it moves higher. Also, too, we can see big money still holding these calls in open interest. But best case, we'll say no case scenario. The stock does nothing tomorrow, right? Let's say the stock does nothing tomorrow. Okay, I get a free ride. Basically, those options are still going to be $1.40 if the stock's at 36.40. Cool. I get a free lotto ticket, and if the stock does nothing, no biggie. Best case scenario, the stock has news, maybe a big pop. Maybe the stock goes up another 40 cents, which is common. Market makers are implying about a 30-cent move. And these options go, let's say, up from 140. Let's say they go up 40 cents. And now these calls are 180. Hey, that's sweet. I could have sold them the other day at 80 cents, 2 days ahead of expiration. But now since I held, I can make $1.80 out of them. Again, when we're playing in the money calls, we're basically playing a stock replacement. I still love the stock. I think it's going higher. Why close out? Is it really affecting my book that much where I can't take maybe a 1 or 2 day move in the option? No. If so, I'm probably trading way too big. Also, too, my whole game plan for this was Dr. Pepper to move higher. It's starting to move higher. I don't want to sell it. I want to be there for the ride higher. If I sold yesterday or the day prior, why would I do that? The stock wasn't moving. So I'm going to sell when the stock isn't moving? No, I want that stock to break out, take out the previous high. And I can do that by trading the option. Yes, expiration soon, but what's really my downside? Now, if I was trading a stock, let's say like AMD, right, which is a crazy stock. You know, the stock can move 2% a day like butter. Now, if I have the, let's say, 78 calls, you can see, yes, they're in the money, but you can see they're about 60 cents just of premium in them. right? Because they're implying a pretty large move in AMD, about $1.40. Now, if I had something like the 80 calls that are 11 cents, well, crap, I need AMD to move at least $2 for those to make money. But even then, would I really close those out? For what? 11 bucks? Do I really need $11 that much? If I have a 10 lot, do I really need $110 that much? You have to think about this, and this is my way of thinking when I trade options. Let's say AMD gets a downgrade and goes from 78 to 75 tomorrow. I have these far out the money calls. I lose $11 on them. If I have a 10 lot, I lose $110. Okay, that sucks. Whoop-de-doo. But let's say I close those out, right? Because, they expire. Expiration's tomorrow. I better close them out. And I get my $110, right? Because I have paper hands. I get my $110. And then AMD the following day, let's say the stock gets an upgrade and it's up $4. And now the stock's at $82. And these options go from 11 cents to $2. At least if the stock goes to 82, right? Because we'll still have some premium. And I have a 10 lot. That's $2,000 I missed out on because I closed them out for that measly $110. If I have one contract, I have $11 I closed them out for, I could have had $200. That's the way I trade options. And if you're worried about, I need to close my option early because expiration, again, you're probably trading too big a position, or you want that little $11, or you want those little pennies. Okay, I get it. You don't want the trade to go to zero, but that time where you have major news on the stock and you miss out on that big move, you're going to be kicking yourself in the butt. It's happened to me many times before. I've seen traders miss out on hundreds of thousands of dollars on buyouts, on big news, because they closed out a trade a few days early because they wanted to make an extra $500 and they didn't want the option to go to zero. So, to summarize this video, if you have an option that's in the money, play the stock. Keep to your game plan. If you have an option that's out the money, now if it's like 80 cents or $2 option, okay, I get it. Those are expensive options. But consider it a lotto ticket, right? Because you can only lose so much that is left. And yes, theta decay plays on the out the money options. But if you have that big pop in the stock, there is always a chance those options can truly rally. And my attitude is never giving up in trading. And am willing to ride it out to the end, because that's how confident and how much conviction I have on my trades out there. So I hope the video helps. I hope you learned something, just how the pros trade options. And again, we're going complex looking at short dated options. If that isn't for you, go pick options 60 to 90 days out. But I will tell you one thing, you're going to pay a pretty penny for those options because they're going to be expensive. So trade small, you could trade often, you could do more positions, you could have more leeway, and that's my style of trading. So like, subscribe, leave a comment, all that fun stuff on the video. There should be a little box. You check, and ring the bell, all that fun, good stuff.